Hey everybody, I hope you're enjoying the festive season. And as we move closer to a new year, closer to 2025, it's time to take a look back and take a little bit of a bird's eye view, as we always do with the charts and the Market Roundup podcast. So let's start with gold and see where we're standing, or where we've got to at the end of 2024. So if you bear with me a moment, I'll just share my computer screen and I will turn off my video camera. We don't need that, I don't think. Okay, that's the video camera turned off. Okay, so this is the gold chart. And as we've moved through 2024, this cup and handle forecast that was issued back in 2019 has played out very well. The cup portion of the chart completed to its target, and we had the handle that we broke out of around about this time last year, last December, January, the early part of last year. We got that breakout, and of course we suggested at the time that we would have a $600 to $800 move up. I've left that label on the chart there, and that's pretty much what we had. We moved up to just a fraction below $2,800. So that was the main move for gold during 2024. And when that measured move completed, we've suggested that a pullback, consolidation, correction, whatever you want to call it, would then take place, and we're still in the process of that. So as we move into 2025, we are continuing with this pullback and consolidation. It could stop somewhere around $2,500 to $2,600, and we've already been down to that level. So that may be the low point for this. But if we're going to see a capital rotation event in the near future, and some kind of market event, if you want to call it that, a large pullback in stock markets, then it's entirely possible that precious metals could get caught up in it for a little while. So a lower target of 2,300 to 2,500 is kind of where I was thinking in my mind's eye. 23 to 2,500 was a likely target zone. So if you're a long-term stacker, long-term positions for the bull market, you might want to think about sort of adding to those positions around about that sort of level. And there is a small possibility that we pull back to closer to the breakout level, which is anywhere between about 2,100 and 2,200. So this kind of zone down here, just above the 3-year moving average, that's a zone that we could pull back to. And you can see the 3-year moving average, that green line, is rising quite rapidly. And in a few weeks' time, it'll be up around 2,100. So a severe market panic type event, something like 2008, where we got the pullback to the edge of the arc there. On this occasion, it could bring us to the 12-month moving average, or in an extreme case, down to the 3-year moving average. So that is how we're starting 2025, with a continuation of the current pullback and anticipating what will happen after that. So the anticipation is going to be palpable as we move through the early months of 2025, as it is going to be with all the other markets as well, in anticipation of a capital rotation event confirmation. This is another way of looking at the chart for gold, and if we take it all the way back to 1980, if I zoom right out, you can see the high point in 1980 on this monthly line chart. If we draw the 2011 high, draw a line to the 2011 high and continue it onwards, you can see why we're pausing where we're pausing right now. And I had suggested this pullback perhaps to around about the 2,500 level. If that was to fail and we fall below that region around 2,500, then we could come considerably lower. I'll just quickly pop this onto the candle chart and zoom in on the weekly time frame just to show you the type of pullback that we're seeing here at the moment. And as it stands, this could very well be a bullish descending pennant, bullish descending wedge. I've been showing you this for a number of weeks now as just a possible scenario, the type of bullish pattern that might form. And I noticed that we had support line here, so I was looking for a possible resistance line to form, and for the whole pattern to form a bullish descending pattern of some type. Because if we're going to break higher, much higher, then we should be forming some sort of bullish descending pattern here, typically a flag or a pennant pattern, and that seems to be what's happening at the moment. So my suspicion is that we fall lower again to 2,500 or even lower. But any breakout above, I'll just move this little label along a little bit now. Any breakout above, let's say 2,650, just to be sure, any kind of breakout above there on a weekly closing basis, and things will start to slowly turn more bullish again. And if I just move this label along a little bit, you can see the upper resistance line is somewhere around 2750. So clear break above 2750, and we'll be on our way once more. But for the time being, as I said, it's a consolidation correction process that we're in. Now, and I should also say, of course, for gold, this will be the highest yearly close ever recorded. If I put the yearly candles on here, the 12-month candles, and I zoom right out, you can see that this latest 12-month candle is the highest ever recorded. So it's the highest yearly close ever for gold. That's not the case for silver. I don't think. I'll check in a moment. If we go to gold versus the S&P and look at the monthly time frame, the gold to S&P chart shows a capital rotation process that is ongoing, and the rotation is slowly away from stock markets and slowly towards precious metals. That process has not completed yet. We need to break out above 0.48 and then above 0.5 to give the confirmation of that capital rotation event. It hasn't happened yet, and that is the anticipation for 2025. And it looks as though 2025 has a good chance of being the year that the capital rotation event is confirmed. If we were to follow this black arrow, for example, then sometime around the middle of the year, the event would be confirmed. Now, moving on to the equal weighted S&P versus gold, we continue to break down, which shows weakness for the stock markets and strength for precious metals. So the breakdown below the Ichimoku cloud, below the moving averages, below the rising support line there. So where we are right now is a breakdown, a back test, and now we're moving back down again. So we could kind of go sideways for several months and not really go anywhere in particular. But at some point, I think during 2025, it's likely that we're finally going to lose, we'll sort of lose the attraction to this zone up here, and this chart is likely to start moving more severely to the downside, which would suggest a stock market rollover. Stock market's rolling over at some point in 2025. The same can be said for the New York Composite Index versus gold. When this chart's going up, the New York Composite Index is outperforming, and when it's moving down, gold is outperforming. So we've seen a breakdown here below an important support line and a back test. So this is a perfect setup for the chart to continue moving to the downside sometime in the next few months, which again suggests weakness in the stock markets and relative strength for precious metals. Now, turning to silver, the silver roadmap continues to play out very nicely. Of course, the very large 45-year cup and handle pattern. If we zoom in on the handle portion of it, that is actually a cup in its own right, but we have a multi-decade large cup and a 15-year handle that has formed. This arc pattern is a handle that has been forming for 15 years, and the target, the handle, is up here in the 38 to 50 zone. We're currently back testing, and we could fall all the way to $26.50 or $28, somewhere in that kind of region. Entirely possible. We don't have to come all the way back down there to test the edge of the arc, but it would look very nice from a technical point of view if we did, and that would be a perfect setup for a rapid reversal upside move into the target area later on this year. So 38 to 50 is our target for 2025. And of course, if we come down to 26 and we move up to 50, or even a little bit more, we could move up to 52. For example, that would be a 100% gain for silver. Moving on to silver versus copper. And actually, what I wanted to show you on here was also the fact that, let me just put it on the 12-month time frame. I'll just get rid of that label, get rid of that, move it up there. Doesn't quite go back far enough. I'll try it on this chart here. So this candle here is sitting at obviously $29.35 at the moment. It is not a yearly breakout. To get a yearly breakout, well, this level, I think Pat's been pointing out the importance of $31. 31 would give us a nice clear breakout of these recent yearly candles here back in the 2010, 11, 12, and 13. So anything above 31 or so would be a yearly breakout. Looking like we're not going to get that unless something dramatic happens. So yeah, so we're closing below the yearly breakout level. It's not the highest yearly close ever for silver. I suspect that is likely to come next year, but watch this space for that. Silver versus copper. Okay, so silver has been outperforming copper. It's broken out, back testing, but the general trend remains upwards for this ratio. So at the moment, silver is in an upwards trend versus copper. If we break down below this black support line here, if we make a clear breakdown there, then we'll be able to say that copper for a period of time is likely to outperform silver, but that's not quite the case yet. Okay, gold versus silver. This is the gold-silver ratio, of course. When it moves up, gold is outperforming. When it moves down, silver is outperforming. And as a general rule of thumb, in a nice, strong precious metals bull market move, you would typically see silver, particularly towards the end of a precious metals bull market, you'd see silver outperforming gold at some point. It's not really happened yet. It's been trending sideways for many years now, the gold-silver ratio. It's moved up and down and up and down, but overall, it hasn't really gone anywhere in particular. So not since this peak all the way back in 2020. 4 or 5 years ago. So the gold-silver ratio has not broken down yet. So we cannot say that silver is highly likely to outperform gold. We can't say that because the chart isn't telling us that. In fact, almost the opposite. The chart is sort of telling us that gold is continuing to show quite a lot of strength versus silver. And if we zoom right out on the monthly time frame and zoom out a lot further, what we can see is that since the 1970s, even 1980 there, the ratio has moved from 35, 40 up to where we are now, sort of 90. So the ratio has doubled. So over the course of over the several decades, gold has outperformed silver over a long time frame. You can see that from this rising support line. Resistance line is horizontal, but the support line is rising. So that's helped to guide the price upwards and squish it ever more just underneath this resistance line. So either we break out above this resistance line and start to move up significantly, or we don't. Statement of the obvious. But as long as we haven't broken down below this rising red support line here, as long as that hasn't happened, then in the short to medium term, then we cannot say that silver is likely to outperform gold. At best, silver is going to match gold's performance, and we might even see silver underperforming gold until we get a break below this rising red support line below that recent support level. Okay, moving on to gold and silver miners versus copper miners. This is AZA versus COPEX, and we'll put it onto the monthly time frame for you there. We are continuing to see gold and silver miners gaining versus copper miners. This ratio is going up. So gold and silver miners are beating copper miners. So whatever the copper miner chart, COPEX, looks like, we wouldn't really be interested in it because AZA, the gold and silver mining chart, is outperforming it. So it just helps us keep our focus on gold and silver miners, particularly once they start to perform well versus the metal. This is gold versus copper. As you'd probably expect, gold is outperforming copper, broken out above the moving averages, the Ichimoku cloud and the resistance line there. So gold continues to look strong versus copper. And moving on to gold versus CPI. This is one of the capital rotation evidence charts because gold breaking out versus CPI is part of a capital rotation event. And when it breaks down, it's part of a capital rotation event in the opposite direction. So the rotation events occur when the breakdown happens, and that's when stock markets outperform precious metals. And then when you get the breakout, marked by these green lines, the upward breakout, that's when a capital rotation event is taking place in favor of precious metals. So where you see the green circles, that's the case. These green circles here showing capital rotation events away from stock markets towards precious metals. That black one there is really a continuation, or that black circle is a continuation of an event. It's a sort of the gold bull market resuming. The gold bull market broke down in 2011, and it was more of a pause than a complete rotation away from precious metals, because you can see that after a very short period of time, precious metals have matched CPI. They've kept up with CPI, and then they broke out again. So particularly when we broke above this red line here, that was the strong evidence there for a developing capital rotation process. So we got the breakout. Now we're getting the back test. So again, wouldn't surprise me at all if we have a full back test of that red line with some sort of event in the stock markets, and then a rapid upside acceleration as the capital rotation event is confirmed. At the moment, it's an ongoing process. This is GDX, and GDX hit our target of $43, and it is dumped all the way back down almost to the entry point on that particular trade, all the way back down to around about 33, 34, well, $34.26. Had reached $43 at one point, or a little bit above $43. So a full retrace all the way back to the entry point on that trade, as I say, and it could very well come all the way back down to the falling support line there, the wake up line, could very well come all the way back down to $30 or so. Wouldn't surprise me in the least. Silver Juniors versus the SPX. Until Silver Juniors break out versus SPX, there is no real reason to be playing around with Silver Junior miners. I don't really see the point. They're volatile at the best of times, and until we get a clear breakout for Silver Juniors versus the SPX, until we get above these double red lines, stay well clear. GDX versus gold, same story. Stay well clear of GDX, stay well clear of gold miners until we get above this breakout line, the one that's the falling breakout line, until we get above the Ichimoku cloud, until we get above this green line, which is the 3-year moving average. And once we get above this horizontal solid black line, the thick black line there, that is when it's really game on for GDX. And that's when you can expect GDX to continue to reliably outperform gold. And certainly once we get above that red line, then you would expect a quick upside move for gold miners versus gold. So in that scenario, gold would be doing very well. Gold miners would be doing even better, exceedingly well, and that's when you really want to be positioned in precious metals miners. This is SIL, the silver miners, one of the silver mining ETFs, and SIL broke out and has given up those gains that it made after the breakout because of all the things that I've just shown you. The capital rotation event has not yet been confirmed. It's a capital rotation process which is ongoing. The event confirmation comes when gold breaks out versus the S&P, which has not happened yet, which means that any moves in the miners are volatile and prone to giving back all of their gains. SIL versus silver, ratio chart that tells us when to be positioned in silver miners and when not to be. And this is why we've not gone into silver miners heavily, because they are not breaking out versus silver. That horizontal black line is an important breakout point, and now we have this rising black line, which is now also an important breakout point. So somewhere in this region, when we break out and we start to break through this orange circle, that's when we can start getting much more excited about silver miners, in preference to silver, if that's your thing, if you want to be buying miners on the in your trading accounts. This is ASA versus the S&P, so gold and silver miners. ASA is a gold and silver mining index with a 50 years of price history. It's identical to GDX. GDX follows it faithfully. So we can take ASA as being a direct replacement for GDX in our charts. GDX doesn't go back so far historically, but ASA goes all the way back to the 1960s. So we can get a lot of data to inform our technical analysis, and therefore get greater degree of confidence about what it is that we're saying. So ASA versus the S&P has not broken out. You can see that gold and silver miners have not broken out versus the SPX. This solid black line, we've got to be above that. We've got to be above the 3-year moving average, the green line, and then we can start getting very excited. GDX versus SIL, so gold miners or silver miners. This chart answers that question for you. And really, over the last couple of years, it wouldn't really have made much difference because it's been up, down, but the net effect is a sideways move since 2022. So there's no great advantage to holding one or the other. I mean, I've already said I wouldn't be holding either. So it's academic at the moment. You shouldn't be really holding a large number of gold or silver miners. You may be holding one or two of the outperformers, but as a broad rule, you shouldn't really be in gold and silver miners yet. It's not the time. Okay. But when we do, when it is the time, this chart will tell us whether we should be more leaning towards gold miners or towards silver miners. If the chart is dropping, then you should be leaning towards silver miners. If the chart's rising, then you should be more into the gold miners. And if silver's outperforming gold and there's a lot of speculative money coming to the market, you would expect this chart to start dropping because the more speculative silver miners perhaps would, with lower market caps or whatever, they would be the ones that start to outperform. Platinum futures, we've been steering you away from platinum for years, and I'm glad we have, because platinum has underperformed massively. It's underperformed gold. It's gone nowhere. Platinum's gone sideways since 2015. So what's the point? The time to own platinum is when it breaks out, but not just when it breaks out. You don't go blindly buying platinum when it breaks out. It has to be beating gold. Okay, so if platinum breaks out on this chart here, but it doesn't break out on this chart, then what on earth are you doing buying platinum? Because if it doesn't break out on this chart, then it means that gold is winning. As the chart drops, gold is outperforming platinum. So only when the chart gets through this red circle area that you can say with a high degree of confidence that platinum is going to enter a more prolonged period of outperformance versus gold. And this is just a theorized roadmap for what would happen in that scenario. So you wait until you get the evidence. You accept that platinum's going to outperform gold for a little while and to get through that red circle. But it's only by getting through that red circle that you know that you are now looking at an era of many years where platinum outperforms gold. And that's when you want to be positioned, as it was here. You break out above the moving averages, above the Ichimoku cloud, and then you have many years where platinum outperforms gold. That's when you want to be positioned in platinum, and that would be when it gets through that red circle. Okay, moving on to silver versus platinum. Interesting to see this chart sort of turning down a little bit, because it means that in the short term, platinum is matching or slightly outperforming silver's performance. So if this chart ever breaks down through this area of highlighted, then that would be the time also to be positioned in platinum, because that would be a clear breakdown from a multi-year support line, and that would then be telling you that platinum is likely to outperform silver for some significant period of time. So again, that's additional peripheral evidence that you would be wanting to be positioned in platinum. Until then, it is all noise. Just ignore what you read on social media. Palladium, again, ignore what you hear on social media. It's been doing nothing for years. Continues to do nothing. It's seeking out a possible cyclical low somewhere down here, but until we break through the 3-year moving average and above that dotted descending resistance line, then what's the point? You have no real evidence that palladium is going to do anything exciting, so it would be a waste of time being invested in it, really. This is silver versus palladium, and it kind of emphasizes that point, really, because silver has massively outperformed palladium during the last year or so. Let's just have a look at to see by how much. So from down here to where we are now, silver has outperformed palladium by 270%. So, why would you even consider palladium? And not only that, but it looks as though silver's trying to break out from this flag. And if it does so, then silver will be continuing to outperform palladium by a very large degree. It's only by breaking down below this horizontal support line here, below the 12-month moving average, that you would start to think that perhaps palladium is going to be outperforming silver. But that's not happened yet, and so there's no reason to assume that that's going to be the case. Palladium versus gold, again, unless the chart starts moving upwards and breaks out above the 12-month moving average, that's the red line there, then there's absolutely zero evidence to suggest that palladium is doing something to enter a period of outperformance versus gold. So do not touch palladium with a 10-foot pole until you get the evidence. Copper futures, well, until we get above $4.75, there's nothing we can say about copper that's bullish. I mean, we've reached the arc target. It's done its thing. This arc pattern, this cup pattern has once again, as it did previously in 2004, it's guided us to the target. We now consolidate in the top right-hand corner. And until we get above $4.75, we can't say anything definitively bullish about copper. And of course, if we enter some kind of recession, then maybe this is going to fall further and form a handle on the cup. Copper miners, we did briefly sort of get quite close to entering positions in the SRS on copper miners, but the breakout wasn't convincing enough, and it's broken back down again. And so there's nothing yet to tell us that we should be getting into copper miners. And as I've already shown you, that copper miners are not outperforming gold and silver miners. This is COPEX versus copper, and COPEX is the copper mining index ETF, and you would want to be seeing the copper miners breaking out versus copper above that red line if you are sort of trying to suggest that something bullish is happening. Quite the opposite is happening, in fact, and we're in danger of making a breakdown here. So there's no reason nothing to attract us towards copper miners. Copper index fund also dropping. Probably get rid of that potential trade there because it's not going to happen anytime soon. Nickel is looking bad. Nickel futures not looking good. Lithium continues to do precisely nothing. I'll pop it on the weekly time frame here. Lithium's down around about 90%. This may be the bottom, but it may not. So wait for the evidence. Wait for it to get above the 36-week moving average there. This is the weekly chart. So above the 36-period moving average, above that horizontal zone of sort of resistance, and through the Ichimoku cloud. So really, when lithium futures gets to around about $15, somewhere around about there, then you can get a little bit more excited and start getting more bullish about it, because then it will be giving some evidence of strength. Wisdom Tree Tin, nothing. This again, we're on the weekly chart here, so nothing exciting about Wisdom Tree Tin. So, and tin futures also breaking down, if anything, so nothing exciting going on there. Aluminium, trying to break out, but not convincingly. It's still above the 36-week moving average, but it's starting to perhaps show a little bit of weakness here over the last several weeks, starting to trend downwards slowly. So nothing exciting happening there. Steel has broken down from this pattern below the black support line. So steel breaking down. These are all industrial metals breaking down or going nowhere. So recession, perhaps. Zinc going sideways at the moment. It broke out above this pennant pattern, but it hasn't got anywhere close to the measured move target, trending sideways. So I'd be cautious on that one as well. Zinc versus gold underperforming. So you wouldn't really want to be involved in zinc related assets until zinc breaks out versus gold. And so we need to be above the 36-period moving average and the Ichimoku cloud. And if, like before, we could break above these black horizontal and inclining or declining resistance lines, if we can break out above them like we did back here in 2020, then that's when you would get excited. But nothing nothing doing there at the moment, so the wait goes on. Iron ore, a little bit of a breakout here, back test. You can fiddle around with this line and perhaps adjust it and put it there and say that it hasn't broken out yet. There's a cluster of evidence here. It's involves the, let me just pop it on the monthly time frame. No, I think it's better viewed on the weekly actually. You've got the weekly Ichimoku cloud horizontal resistance line, the declining resistance line. So there's a whole batch of evidence inside this circle. It's what we look for. We look for being able to draw a circle on the chart that contains a lot of technical resistance from the cloud, from the moving averages, from resistance lines. And if you can fit them all into a small circle, then you know that by breaking through that circle, the evidence would become strong that you are into a new bullish phase. Not happened yet, so that we can't say that. Moving on to uranium, spot uranium, looking weak. I'd suggested a long while ago that it's possible we could form a handle on this cup, and this latest bit of price action where we're breaking down now below the edge of the arc confirms that. So spot uranium is in a significant pullback after hitting the recent highs well above $100. We are now moving down. We're around $70, so it's a 30% decline in spot uranium prices. Therefore, the URA ETF, our decision to step aside from that has been the right one because it's gone nowhere really for many months. And so opportunity cost and all that kind of thing. We were better positioned in gold over through 2024, whilst uranium did precisely nothing, and the uranium miners have done precisely nothing as well. So the URA ETF, a sideways move for the last 12 months or so, and that continues. And we're showing further weakness here with a potential move that could come down to the 3-year moving average or the Ichimoku cloud. So further downside is possible. The uranium miners versus the metal pulling back. So that's another sign of short-term weakness. I suspect when this eventually begins its next up leg, it'll be quite dramatic, but we want to try and time that right if we're going to get involved in that. The uranium versus gold, this chart, this will really help us actually. So if we're pretty confident about what we're saying about gold and silver, i.e. that we're in a consolidation pullback at the moment with a new uptrend very, very likely to develop in 2025. And when it comes to uranium, this chart is really going to help us because only by breaking out from this consolidation phase in uranium versus gold, only by breaking out of that, would we really want to consider going into uranium miners, because if they're not outperforming gold, just position yourself in gold. I know some of the miners might pay a dividend, so you need to take that into account as well. But if uranium miners are not outperforming gold, then they're not in a proper bull market. Uranium miners will massively outperform gold in a strong bull market, and breaking out through that red circle would mean that we're breaking above the moving averages, the Ichimoku cloud, and the resistance line, and that's when you want to be in the uranium miners. And so that could be very exciting for us later on in 2025 or even 2026 perhaps, but it's quite likely to happen this coming year. Moving on to sugar and the soft commodities coming up here. So sugar is showing weakness, pulling back to the edge of the arc, and could continue a little bit lower without breaking the bullish pattern. Could come back down to 18.5 or so on the chart here. Soybean futures looking pretty weak, but that candle there, that monthly candle, could be a sign of hope for soybean futures. But no strong evidence yet, and we need to break above this red circle really to start entering a new strongly bullish upwards trend. We need to be above the 3-year moving average, and that's probably where it's going to be in a few months' time. Corn futures starting to show some strength here. This could be a bear market rally, and until we get above the 3-year moving average, we can't be certain. So we need to get above, well, in a month or two's time, that 3-year moving average is going to be somewhere around this 534 level. So let's see if we can get above that. And if we can, then there would be much more confidence of a developing bullish upside trend. The Tokarev Corn Fund also starting to show signs of breaking out. Again, it could be a bear market rally. That horizontal support and resistance level around about $17 or so. That could have been the low there, but we need to get above the 3-year moving average, above the Ichimoku cloud. Then we're into bull territory. So it's a case of watch and wait for corn. Wheat continues its downtrend for the time being. The big picture is a sort of a rising channel type of thing with a upwards resistance zone and a lower support zone. We're getting closer to that support zone, haven't quite hit it yet. We could come down to closer to $480 or $500, that kind of area. Cotton is looking pretty weak, hasn't broken out yet, and there's a long way from the evidence cluster up here where you find the 3-year moving average, horizontal resistance, and the Ichimoku clouds. So cotton, nothing too exciting going on there. Coffee futures, very close to hitting my target area around $3.60. I think we got to about $3 and what was it? $3.34. So that may be the high point. Maybe not. Maybe it continues to rally upwards for a little bit longer, but that would be the measured move around 350, 360. Hasn't quite reached that yet, so there could be a little bit more juice in the tank for that. But as long as we're above a rising 12-month moving average, then that remains technically pretty bullish. You can see previously it started moving sideways and then broke down below the 12-month moving average. And that's when it entered a longer corrective period. So I'll stick with my target of 350, 360 and see how that pans out. Cocoa futures, that's looking like a warning sign there on the. In fact, I'll just put that line back on, and I'll go down to the weekly time frame. So that was my sort of target level, the previous high. That's when you break out here, the initial target is always going to be the previous high, and then anything after that, is kind of icing on the cake. Well, we've hit that level. We actually exceeded it, and now we're breaking back down well below that. So all I can say is that the initial target's been reached for cocoa, and it may take some time to consolidate, correct. We don't know whether it's going to break down, come all the way back to where it started, or whether it will mount a more sustained upwards move. But the initial target's been reached is all we can say. And for now, the downside target might be somewhere here where I've highlighted somewhere around $8,500 per ton. Moving on to Organogram, which is one of the cannabis stocks, and hasn't broken out yet on this weekly chart. Still below the 36-week and the 36-week moving average and the Ichimoku cloud. So that pullback or bear market, I should say, continues. And the one of the ETFs that we follow for the sector has broken down below this support zone. It had been a support zone, and it's broken down below that. So cannabis sector looking weak. The DB Agriculture Fund, oh dear, what's going on there? That was a strong upwards break, and now a gap down by the looks of it there. I'm not looking too clever there on DBA. We did think about potentially adding that to the SRS, but other evidence and concerns sort of dissuaded us from doing that. But nevertheless, it did move upwards quite strongly before this recent downwards break. I wonder if I just readjust that there. It also makes some sense to have that as a support and resistance line, but in any case, for the time being, caution is warranted. Natural gas futures, they're down nearly 9%, and until it breaks out above that, I'll pop it on the monthly time frame. If it breaks out above that declining black resistance line, then we might have a shot at moving back towards $9.50 or so, but currently languishing below the $4 mark. The US Natural Gas Fund also looking equally unconvincing, I suppose. It's not really done much for the last year or so. It's just gone sideways. The DB Commodity Index Tracking Fund breaking down below support here. So it's the first time it's done that. It's been holding on to that support level, indicative perhaps of the likelihood of a recession developing. Until we break out above the 25 to 27 level, we cannot be strongly bullish on this. We haven't been bullish on it really all the way through 2024 and really since it peaked. Moving on to the Bloomberg Commodity Index Futures chart. Again, we can't be bullish on that until it gets above the 36-month moving average. The CRB index looks a little bit more bullish there. It's holding onto that support line. It is above the 36-month moving average, so we'll continue to track that one. And I've previously said if it gets above approximately sort of $300 or so, then we can be much more bullish about it. But it's really been in a long consolidation correction since 2022. Moving on to the oil chart for West Texas oil. Now this one is continuing to consolidate in the bullish pennant there that has formed, that yellow flag pattern that's formed above the resistance line. So crude oil, it's a very bullish setup, but it needs to break out above the sort of 75, $76 level for it to start turning more notably bullish. Brent crude, same sort of thing. It's in a pullback pattern on top of what was a resistance line. It's now a support line. And again, we won't be turning strongly bullish on this one until it gets above that red circle there. It breaks out and gets above the 36-month moving average, which is somewhere around about $86 on Brent crude. And then that would be when we would be enacting a target of $200 or more. Brent versus gold was worth keeping an eye on. Oil versus gold, and just starting to find a little bit of a footing here. Quite a considerable drop, as you can see, with oil underperforming gold. Just starting to get a little bit of purchase there on what might be the edge of a developing arc pattern. So we'll keep a close eye on that, but only by breaking above the 36-month moving average in the Ichimoku cloud will we be really strongly bullish for Brent versus gold at that point. Coal isn't doing anything too exciting, and neither is coking coal there. One of our members asked if we would include that chart, but nothing going on there. XLE is the one of the energy select sector fund. Tricky chart to analyze because we have to really break above that rising resistance line before we can start turning strongly bullish. Hasn't done that yet, and it's just bouncing on support around the 3-year moving average. So continue to track that one. The XOP chart, oil and gas exploration and production, very long sideways consolidation for the last couple of years. If we break out above approximately $155, $160, that kind of level, then that will enact, I think, a more significant upside move. So that will be interesting to see if that happens in conjunction with oil breaking out. But for the time being, we can't be bullish on either oil or the XOP chart. Now we've got the US dollar here, the US dollar index. And it's been moving up to the 107, 108 area. I'll pop it on the weekly time frame. You can see the breakout. I might just get rid of this diamond pattern now. It's probably not necessary. Get rid of those red lines and just focus on the breakout that occurred around about the 105.5 level, 105.68, that sort of area, and breakout and a very clean back test of that line. So that's a very bullish setup and does suggest that we are likely to move higher. I know it goes against what a lot of people have been saying over the last several months, expecting US dollar index to be very weak and therefore to help gold and silver. But our position has always been that the chart itself for the US dollar index looks bullish and that a gold and silver correction is ongoing. So it would not surprise us at all if we move up to somewhere between 110 and 115 on the US dollar index, and the kind of damage that would start doing in the markets would tie in with a capital rotation event leading to big drops across general equities, and then eventually leading into a drop for the DXY and providing tailwinds for precious metals. So that's the roadmap. So in the short term, further strength in the DXY would not surprise us one little bit. The euro dollar, of course, the euro is a large part of the DXY. The euro, I think, is about 58% of that. Actually, it says up there that 58%. The euro is 58% of the US dollar index. The US dollar index, or DXY, is of course just a comparison of the relative strength of the US dollar versus mainly the euro, but also Canadian dollar, British pound, Aussie dollar, Japanese yen. I've probably forgotten one or two there, the Swiss franc. So yeah, the DXY is just an index comparing the US dollar to a bunch of other currencies. So anyway, the euro is the main one in that in that index, and so if DXY is going up, that means the US dollar strength is rising versus mainly the euro. So the euro dollar chart then goes down because the euro is underperforming the dollar. And we can see that parity is entirely possible where €1 equals $1. Moving on to the Swiss franc versus the euro. The Swiss franc is dropping versus the euro, and the initial target is somewhere around about 1.09, 1.08 maybe. That's the initial target that seems highly likely at the moment. We could drop it down as far as the support at 1.055. And at that point, I would expect an upside reversal and for the Swiss franc to start outperforming the US dollar. And that is what is needed for a capital rotation event. We need to break above the red resistance line, and that would confirm a capital rotation event. Because if we zoom right out onto the monthly time frame, you can see that each time or when we have a capital rotation event like we did in 2002, the Swiss franc breaks out versus the US dollar. So it's one of the pieces of peripheral evidence that we look at and that we need to give us the confirmation and the confidence that we need to be able to say to you that the capital rotation event has happened. It's a capital rotation process at the moment that is ongoing, but the event confirmation cannot be given until these pieces fall into place. The British pound had a false breakout versus the US dollar. This falling wedge broke out, hit resistance, reversed, and we could have parity here as well. If this falls all the way down here, then £1 equals $1 nearly, close to that anyway. The initial target is 122. We're at 125, 126 at the moment. The initial target would be 122, and then we'll see what happens after that. The Aussie dollar versus the US dollar breakdown. Very clear breakdown here. What's the target for this? I mean, there's not a lot to stop it getting down to 0.59. So another 5% drop from where we are at the moment. I think that is. I'll work that out in my head. It might not be quite as much as 5%. Let's have a look. Yeah, actually, yeah, around about 5%, 4 or 5%. So Aussie dollar is losing the Australian dollar is losing ground to the US dollar, and this is the US dollar versus the Canadian dollar showing a clear breakout on the monthly time frame. So the Canadian dollar is losing strength versus the US dollar. When this chart moves up, the US dollar is winning. So that's a clear breakout. And just how high that's going to go, we'll have to wait and see. But I suppose there's an initial target somewhere around 151, 152, something like that. A little bit of a wall of resistance there. The S&P, the S&P 500 weekly time frame, and let's just zoom in a bit. Showing a little bit of signs of weakness here. We've broken back down below the blue support line. Rising wedge pattern. We're back below the blue support line. I think if I zoom right in on the daily, you'll see it's a back test. So we broke down, back tested the blue line, and now we're reversing again. So some kind of messy breakdown is entirely possible here. Zooming back out to the weekly time frame, things get really serious if we break below this red circle sitting around about 4,800 to 5,000. So if we break below that, if we were to drop another 1,000 points on the S&P, and at that point, I think gold versus SPX might be starting to get close to breaking out, or may even have broken out. So that would be capital rotation event confirmation if we break below that red circle. The S&P equal weighted index has already broken down quite clearly. It's not looking great. So the equal weighted S&P, yeah, that's a definite breakdown on the weekly time frame. The S&P volatility index had a little bit of volatility just recently. It spiked upwards, but overall, we are still, and if I zoom out on the monthly time frame, we're still below that red. So it was a support line, it's now a resistance line. So S&P volatility is still relatively contained. The Nasdaq 100 on the weekly time frame here is still in a bullish uptrend. As long as we're above the 12 and 36 week moving averages, which we are, then it's in a bullish uptrend. As long as we have not broken through zone A, it's in a bullish uptrend, and that is still the case. The moment we break below zone A, below the rising support line, then we start to think more in terms of testing zone B. And of course, we're at 21,500 at the moment. So coming down to 16,500 would be probably enough to give us capital rotation event confirmation, and any movement below zone B, and that is much more serious and long-term damage. Nvidia, again, it's one of those charts that's starting to show some signs of weakness, and if we were to look at some of the technical indicators, there's some negative divergence on some of them that's starting to show up, and this rising wedge can be a sign of trouble. In a very strong bull market, rising wedges just keep breaking to the upside. And there may be one down here somewhere. Don't know if we had some kind of rising wedge in here, did we? Probably not actually. But I think I've shown you before that rising wedges aren't necessarily bearish, but they can, when they break to the upside, give a very vigorous period of upside price movement that then ultimately sort of causes a burnout. And sometimes the bearish rising wedges, do occur at the top of a bull market as well. So this little breakdown here is something we need to keep a very close eye on. And if we were to fall below the 36-week moving average, so below about 122, then we've got more serious issues. You can see this rising red line that says no problems above here. And you can see we had one previously, no problems above here. And as soon as we broke below it, it took a while, but we eventually fell 68%. And the same thing previously, no problems above here. Then it broke down below it, fell about 18%. Then it regained that. And then the real trouble started, and we fell again around about 57, 58%. So if we were to break down from this current position here and drop down to support again, that would be a much bigger drop, probably more than 58%. It would be more like nearly 80%. So there is risk and danger there. The Dow Jones, yeah, so this chart had a sort of target up around 49,000 or so. If the stars aligned and nothing bad were to happen, then there's a measured move target or a distance from moving average target that would take us up there. But we've sort of pulled back quite a bit from the recent highs near 45,000. We're currently sitting at 43 or so. And so again, any movement below the 36-week moving average, 41,000 or so, that would make us start to have more, make us sit up and take interest a little bit more. The Russell got all the way up to nearly 2,500, and we're down at 2,244 at the moment. But as long as we're above this rising blue support line, nothing too dramatic has happened. If and when that rising blue support line were to fail, then the target would be this black line here, somewhere down near 1,900. So So far it's okay. There's no problem so far. So again, nothing terrible has happened yet. The Japanese Nikkei continues to sideways consolidate around the 40,000 mark. Again, nothing too dramatic going on there. And the FTSE 100 doing the same thing, really, sideways consolidating since the earlier part of this year. Nasdaq Emerging Markets reached its target, which I'd previously sort of shown you as being somewhere around about 12, 1300. It's pulled back from that. A clear move above the 1300 area would set up a potential target up around 1700 perhaps. The Hang Seng is going nowhere really. It's just hanging there, not doing very much. We can only be strongly bullish if it breaks above the red resistance line. Until then, the bias is more neutral to bearish, but having broken down below support and still being below the Ichimoku cloud. So yeah, the Hang Seng is neutral to bearish. The crypto total market cap chart is neutral to bullish at the moment. We're in a pullback consolidation phase. We reached our measured move target from this breakout here. So that move there in the early part of 2024, prior to the consolidation that took place, that was replicated. That move was replicated in distance, and we're now consolidating, pulling back. It doesn't mean it's the end of the bull market. It may be if stock markets roll over and we have a major problem. It may be that we've hit our bull market peak, but there's no reason to necessarily think that just yet. Crypto total market cap, excluding Bitcoin and Ethereum, also has reached its sort of measured move target, continues to consolidate and correct. Bitcoin, same thing. Again, this red arrow here, it replicated that move from there to here. And so that measured move was reached. Consolidating, correcting at the moment, and we'll continue to track that for you. Bitcoin dominance, well, we broke down from this rising wedge pattern, but we've hit the Ichimoku cloud on this weekly time frame. We bounced all the way back into the support resistance zone. So continuing to track Bitcoin dominance, and a renewed breakdown below about 56% would start to, I think, get the altcoins really heating up again. Total 3 versus Bitcoin. So this is the altcoins versus Bitcoin. We broke out, and now we've reversed that breakout, and we're all the way back down to this horizontal support level. So something odd going on, because that doesn't normally happen. You can see the last alt season we just sliced through. Well, once we broke out above the Ichimoku cloud, which we did down here, I suppose we broke out here, didn't we? And then dropped a lot. It's very volatile. The altcoins versus Bitcoin, the alt season itself there really took off when it crossed this level that we're at the moment. So this level is quite important, and also because we're close to the Ichimoku cloud. So this horizontal support and resistance level has a clear significance. The trading volume is interesting because when we topped here in 2021, you can see this trading volume, and we've had the same trading volume at this recent peak. So it's interesting to just note that, and the trading volume dropping off again. So I'd want to see a renewed upside break, and I really want to see us above that black dotted line up there to really give a strong signal that we're in a really strong alt season, for want of a better phrase. Hut 8 is has been outperforming Bitcoin, and you see the Hut 8 chart here. Broke out, back test, moved up, and back testing again. So I don't know what else I can really sort of say about that at the moment, except that Hut 8, I think, continues to do reasonably well versus Bitcoin. I've got the ratio chart here, and you can see that we've moved up from March, April time to where we are now. So Hut 8 overall has outperformed Bitcoin. Hut 8, of course, is one of the Bitcoin miners. And there's no reason yet to assume that it's going to sort of start faltering and breaking down badly. It's just struggling a little bit in the Ichimoku cloud here. And I suppose if we go down below the 36-week moving average on there, and often the cryptos like the 50-week moving average, so I'll just pop the 50-week moving average on this one. If we break down below the 50-week moving average, then that would be a little bit more concerning. You can see the 50-week moving average has acted as support and resistance at times in the past. So any movement below that 50-week moving average, and then I'd be a bit more concerned for Hot 8 versus Bitcoin. Bank of America still looks fine on the monthly time frame, no problems. It's above the rising blue support line, so I'm not worried about the banks yet. The Baltic Dry Index testing the edge of the arc. We should start to see some strength returning to the Baltic Dry, but of course, recessionary fears or an actual recession could rewrite that chart and could redraw that chart, of course. So we can't be bullish until we are above the 36-week moving average, which is let me just pop the 36-week moving average back on here. That's a 3-year moving average. And the 3-year moving average is at around about 1647. So yeah, and the 3-year moving average is starting to drop here, which is never a good sign, actually. So we can't be bullish on the Baltic Dry at the moment, regardless of the fact that we've got a potential possible arc pattern here. We can't really be properly bullish until it gets above the 36-month moving average. The 10-year yield chart is interesting. If we zoom right in, you can see the 10-year yield is or has broken out above this declining resistance line, and it's now hitting this potential resistance line here. Depends how you draw your support and resistance line, but I think there probably is a little bit of resistance in this area, roughly where this red dotted line is at around about 4.6%. But any further upside movement, and it's going to probably give us a target in excess of 5%, which would no doubt cause a lot of issues as well. And if we zoom right out, those of you that have been following me for a long time will be familiar with this chart. We've broken out of a 40-year descending pattern where the 10-year yield was contained below the pain line. Then we crossed the pain line after a false breakdown in 2020. We suggested an upside breakout was coming, and of course that is what happened. We broke out and we moved up close to that. Well, we actually moved up to the 5% level pretty much, and we've been consolidating around there ever since. We haven't had the big breakdown that a lot of people were expecting, down to 2.5% or so. That hasn't happened. So no doubt that's causing some economic issues in the background. And the 10-year yield minus the 2-year yield chart, or the yield curve inversion, is now moving rapidly to the upside. And when that's happened in the past, we get a serious event, which is later given a name: dot-com bust, the Asian crisis, the 90s recession, the subprime crisis. So all of these reversions to the normal condition, so moving from a negative number to a positive number, when that happens, you get some kind of market panic event, and also you get a recession. If I put the US recessions on, you can see these green zones occur after the chart has moved back above that horizontal red line, the 0 line. So when we're back above that 0% level for the 10-year yield minus the 2-year yield. So it suggests an event is coming, it suggests a recession is coming, it suggests plausible deniability and distraction are coming, and it suggests a high likelihood of a high impact economic, geopolitical, market event. Something is headed our way in 2025 is what that's suggesting. Okay, on that cheery note, as always, I always put this chart at the end, and it always ends the market roundup on a sort of a negative note, I suppose. But it is what it is, and it's an important chart. So I think we need to keep returning to that chart as we go through 2025. So lots to anticipate in 2025, and I hope you all have a happy, healthy, prosperous 2025 as we move into the new year. It's only a couple of days away now, 3 or 4 days away. So, yeah, enjoy the next few days. I'll endeavor to put any posts and charts onto the website that catch my eye that are particularly important. There's not a great deal of trading going on at the moment, I guess. Things are fairly quiet in the markets, but if anything, particularly with cryptos, changes materially, if there's any material change in any of the markets or any of the charts, then we will be sure to let you know, and we'll be back with full effect in the early part of 2025. So, yeah, have yourselves a great New Year celebration if you're celebrating New Year. I know Chinese New Year comes at a slightly different time, and depending where you are in the world, you celebrate these things at different points in time, whether it's Christmas celebrations or whether it's your religious celebrations or whether it's New Year, whatever it is. Do enjoy the festive season and have a great 2025 when it gets here. Speak to you all again very, very soon. Goodbye for now.